half the stocks in that index are actually below where they were on the lows of October 13th, meaning we are so dependent on just a few, and that usually ends poorly.
Well, to use the cliche. Welcome back to the exchange. Just a handful of stocks responsible for the recent rally, but how long can they keep holding up the market? Deirdre Bosa has more in today's Tech Check. Tech Check. Dee?
Good old Tech Check. To get an idea, John, of just how much mega cap tech is leading the market this year, look at this chart from Bank of America. It tells you that we are currently seeing the greatest outperformance of tech versus the S&P 500 ever. We'll get that chart out for you, but you will see that the previous two times we even came close to this kind of gap. There it is. They were followed by major tech busts. Now, of course, tech looks a lot different now than it did back then. It is more concentrated in a handful of companies worth hundreds of billions and trillions of dollars with real earnings and diversified business models. And it's partly underpinned by that transformational platform shift in AI that has not been seen since the advent of the iPhone, the internet, or the Industrial Revolution, depending on who you ask. Given their size, though, this run-up this year has been astounding. NVIDIA, Meta, they have more than doubled in value. Google is up 14% since that I/O event last week where it came out with its generative AI search model. And Amazon is up nearly 6% this week. So,
Dee, it's so interesting. There's a huge difference between how the biggest tech names are responding, and I'd even throw Oracle in there. It's huge. And just some pretty big tech names. You look at semiconductor names year to date like Qualcomm, like Texas Instruments, they're flattish. IBM, which had a great 2022, flattish to down. So it's not tech across the board necessarily that's outperforming, right? It's the very biggest market caps.
And it is so concentrated, right? That's what you're getting at. It's sort of these 8 names that have basically accounted for all the S&P's gains this year. And, you know, I think that you were talking about this with your last guest before the break, kind of seen as more recession-proof and maybe a safe haven because of those gigantic balance sheets. And that's really what's different this time than those previous 2 peaks, is that, you know, these are fortresses. They have so much money on their balance sheets. And even though growth may come down and has come down for them, they're just seen as safety plays.
All right. The view from Techland, literally with the Bay Bridge behind you. Dee, thanks. Let's dive deeper now into the charts. My next guest saying the move in tech is overdone. It's time to reduce or hedge long exposure in the sector. Let's bring in Carter Worth of Worth Charting. Carter, is this tech overall, or is this the very biggest tech that it's time to rotate out of? Because there is a difference, is there not?
Absolutely, just what you were citing. A major difference. But I think before the concentration issue that you all are discussing is important, but it's always with us. If you look back over the last 35 years since the beginning of GICS data from Standard & Poor's, the top 10 stocks on average are about 20% weight. But now the top 10 are 30. And of course, you know the top 2, Apple and Microsoft, are almost 15. And the last time we were this concentrated in 2 names goes back to 1978, AT&T and IBM. Obviously much smaller companies now. But what we have, of course, is a big milestone this week. The S&P 500 information technology sector just this week recouped all of its losses relative to the S&P associated with the dot-com peak. And we might have a chart of that, but what it is a testament to is the problem with overpaying for something. In real estate, in the market, in anything. And so that's a long time, 23 years and 3 months, just to get back to even with the general market.
Well, that's
now, the preceding chart you had there.
That's what it's a testament to, but I got to stop you there because it looks like this isn't the first time we've bumped our heads on that ceiling, right? Or close to it. So what is it also a signal of?
Right. So the other chart you had up there prior to my coming on was going back to 1974. Now, again, in 1974, there was little to no tech, and IBM was probably half the weight of the sector, and IBM was the most valuable company in the world at one point. Before, in principle, exceeding a former high, any stock, currency, index, commodity will have to contend with it, which is to say, we're here at a level where you're likely to back and fill at a minimum or back away. Hence the judgment to reduce exposure to the largest names, NVIDIA, Apple, Microsoft, and do what you maybe were intimating, double back and look at some of the mid-cap names that have lagged and play those for catch-up.
Okay, and how are we looking in the way some of those mid-cap names or indices charts look versus, today's, flavors of the decade. You mentioned names like AT&T, for example, and IBM that are not the flavors now. Intel, I'd throw in there for a couple decades ago as well. So maybe the big names are always popular, but the big names are always changing as well.
Ever changing. And in fact, of course, we know, think about it, U.S. Steel, of course, now going back a long way, most valuable company in the world, General Motors, GE. And so it's ever changing. And again, this will happen too. One day, Apple will not be the thing that it is, and Microsoft as well. But for now, they are the kings. The question is, are they a little bit steep, uncorrected, or in the fundamental parlance, are they expensive? I suspect it's right to reduce exposure.
The whole market's expensive, but these larger companies are especially expensive. So does that mean X these larger companies, maybe some parts of the market are reasonably priced when you look at the charts? How should investors at home think about that, relatively speaking?
Sure. Well, we have such a bifurcated circumstance throughout the market, and not only tech versus the market, but let's take consumer, for instance. You have restaurant industry groups making all-time highs, home builders, and yet retailers are at 52-week lows. And one of the problems with bifurcation is it's almost always resolved by generally lower prices. And so consider this fact. The Russell 3000, right, represents 98% of the investable capital in the United States. Half the stocks in that index are actually below where they were on the lows of October 13th, meaning we are so dependent on just a few, and that usually ends poorly.